Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Tuesday, April 5th, 2022. I'm going to start out with a brief update on the equity markets as well as the VIX Volatility Index, and then cover some new trade ideas. I'm going to cover quite a few, well, not too many, it looks like I have about a half a dozen individual sectors. And most, not all, but most of these have sector ETFs. So that's one way to trade as well. You know, when you trade the broad market, especially if it's your SPY or the S&P 500 E-mini futures you're trading, or any derivatives thereof, um, you're going to be trading at any point in time the 11 most, or I should say the most bullish sectors in the S&P 500 in the stock market. There's 11 sectors total in there, 500 different companies, and you're going to be trading the most bearish, and that's again at any given point in time during an uptrend, during a downtrend. And so when you move over to QQQ, it's a little more concentrated play. Even though it is an index, it's mostly tech. It's about 50%, maybe a little over that, in tech companies. Doesn't have any financials, and so you have a more concentrated play. You could, in other words, you could trade XLK, the tech ETF, or QQQ. I'll show you XLK. Charts are identical, and they're always going to be, because due to the weighting and the components in there, nearly identical, of course. All right, so this is QQQ. The big takeaway is we're still here. This is these are the 200-day moving averages in blue and red. The blue one is the simple moving average. The red one's the exponential. And so far, it's been this blue line, the simple moving average. And once it was broken on this big red candle, that's capped every advance, including last week and so far this week. And that is typical in a bear market or a large correction. Once you take out the 200 days, and I'm sorry for any confusion. On this weekly chart, they're shown as 40-week moving averages, because there's a 5 calendar days in a week. 5 times 40 equals 200, and so a 40 period moving average on a weekly chart is the same as a 200-day moving average on a daily chart. All right, so that's it. We'll see where we go from here. You guys know my thoughts. I'm still leaning towards more downside this year, including my targets T2 and all the way down, most likely to here to T4. My fourth and final target, if hit, it's going to take us down back to where we were just before COVID hit in 2020. And there's also some very significant bull market uptrend lines that come off the bull market lows back in 08, 09 in the Nasdaq, and those come into play as well. So that's the most likely scenario still at this point, in my opinion. Don't want to see this rally go much further. We are also right now, we're still a hair shy. It's been just under a 61.8 Fibonacci retracement of the entire move down into the recent lows. That means those are key fib levels, and we're still below that 61.8 fib and the 200-day moving average. So unless those are taken out, I'm going with what the longer term charts say. I know this recent rally feels bullish and is bullish. From a very near term perspective, we took out the downtrend line, the bullish falling wedge on the 60-minute chart. That's what it looks like here. And that was the technical catalyst. All right, so that's that. I don't want to spend too much more time on it, other than to show you there's what it looks like on the daily chart. And you can see here on the daily chart, these are the rejections so far off the 200-day, how it's capped it, just like it capped it back here on numerous occasions, with one brief daily close, marginal close above it, and one there as well, followed by a rejection, and then the downtrend resumed. So we'll see. That's bigger picture. Short term, go down to the 60-minute chart. This is what I've been focused on lately. You had this, this was the tail end of our big bullish falling wedge when we put in this divergent low and then double bottomed right there. So that again was the technical catalyst. We successfully held the lows and then went on to break out of that bullish falling wedge right there. There was your positive divergence. That was the breakout right here, and this was the move. The measured target would be the widest part of the wedge, which, to do it exactly, would be take the widest part from right here to the top there. That gives your measured target, add it to where it broke out, and so far we're still shy of the measured target. And that would be, it would be ideal to see it fail shy of the measured target, because in a bull trend, what I'll say is often that in a bear trend, if the larger primary trend is still bearish with another leg down to come, and of course that's a big if so, then it is common to see bullish chart patterns fail to play out to their measured target, just like in a bull market. If you're shorting rising wedges and things like that, they usually don't play out to their full measured target or beyond that. So that's what I'd like to see this be the end point for the rally. So what do we look for? We look for previous reaction lows to get taken out one after another, and then each one's a check mark. Right now we have some check marks. In the bull case, they took out some, again, after the wedge broke out, they took out a few previous major reaction highs, but they stalled at this one so far. So that's it. And just to wrap it up, to just tell you my thoughts, are my convictions super high? No, only because we took out some of those previous reaction highs, but it is still, like I said, that's still the way I'm betting. I mentioned, told you guys I started layering in some shorts recently up to here and have a pretty decent short position. I still maintain my near-term targets that I laid out for you, which were the 357.15 level. Remember, cover just shy. Effectively, as I said yesterday, effectively it's been hit because it came close enough with a decent enough reaction to say that the buyers stepped in a hair early, and so therefore I think if we come down, we may get a second reaction. I would probably say at least a little reaction, but I wouldn't try to game it. I don't think it's worth it. I think if we get back down there, we're going to take it out and then hit that next target there about 351.70. Of course, there was this smaller wedge here, and sometimes that's all it takes, again, especially if we have another major leg down coming in the coming months here. A small little seemingly innocuous, rising wedge like that could prove to be, the catalyst for the next leg down. Well, again, only time will tell. Okay, and I promised you an update on the VIX trade. This is VIXY. Remember, they are retiring that VXX. So you can either, there's a lot out there, but for short-term futures, this one or UVXY if you want to juice it up. To me, in my opinion, there's enough volatility in the VIX as is. You don't really need the leverage, but if that's your thing and you want it, great. You just need to know that you need to be more precise on the timing when you're going with a leverage ETF in a very volatile index. In other words, they work well. The leverage can work to your advantage in a strong unidirectional move, but when you get in those choppy, grindy periods, that's when you get the decay like that. So you want to be long there. Anyway, this is a 60-minute chart, and what you're seeing here, to me, simple stuff. There's no guarantees, but this is what I look for. Just like we have the divergence on the indexes, the VIX is almost a mirror inverse of the markets. So right there, you had positive divergence at that low, and you had not a great trend line. None of these trend lines were great. If I draw that way, you had a little false breakout, then a back test, a marginal new low. But the key is you put in the divergence. You didn't have the divergence there. This one, same thing, positive divergence right there. On your indicators between price and again right here, and it was also a pullback to support, as I mentioned recently. So you had a couple entries around there, and just to measure it out, and again, this is the non-leverage one. That pop was a mere 60%. This pop here was a mere 56, almost 60%. And there's certainly the potential for that or more. We kind of going around. Remember, this is not the actual VIX. You can't trade the VIX directly. You can trade futures or ETNs that track the futures or options on those futures. But so far, we're hanging in there. The VIX is holding up despite this stock market rally. And let me just show you the VIX futures that I gave you the other day. Here's the May contract. Probably the best one to be in at this point in time. I believe it has the most volume, or should by now. You have positive divergence right there at the lows, just like on the, and this is also a 60-minute chart. And a couple trend lines, again, none that I'm crazy about because there's not too many reactions to define it. But you had this one here, and a little breakout and a back test right there. So here, breakout right there, and a back test, and targets remain You could probably target a little higher, somewhere roughly $25 right there. I think you can make the targets out. I've already posted this chart on the site, so you could check that out. Okay, and as promised, let's talk sectors. I'm going to start out with SOX because this is actually an existing trade. I laid this one out for you several weeks back. The last update, I'm gonna make some changes to the chart. I left these lines on there just to show you why. I had a potential flagging action there. I wasn't crazy about it. It was sort of an oversized flag, not so proportional to the at least it got a little too big, so I'm removing that. However, the crux of why this is a short, you had this is a weekly time frame, by the way, bigger picture stuff. So you had a uptrend line right there. Most important is this big divergent high. Look for these divergent highs on the weekly. I've measured them out, showed you where they were before. This divergent high gave you a 39% drop. That one was double digits. I didn't measure it there. That one was 27% drop. And you go back over the years and you see, especially during bear markets, much bigger. These are only simply bull market corrections. And you're looking, 30-40% on those. And so this one right here, I think there's more to come. We are below the 200-day moving averages right now. Again, that's usually where you enter major correction mode. You took out the 200 days right there, same as a 40-week on this weekly chart, and you back tested right there and got rejected with another leg down. You took it out right there. That was COVID. And then you recovered it there. So it's bullish when you solidly recover the 200 days, just like the stock market, especially tech-heavy indexes like the Nasdaq 100. And so far, we've taken them out, and we've been back testing, trying to regain it, and stocks has failed to do so. So I listed this as S1, support one, weekly, especially a solid weekly close below that, 435.83 should do the trick, take us down to my first target, which is more of a target zone, runs about 382 up to about 388, but close enough. You can cover anywhere in there, or just trail stops down if you get there. That's about another, oh no, I need to measure this way. That's about another 17% or so down below current levels. And then this one would coincide or mesh with my broad market outlook, T2, and that would be down to about the 271 level. Again, from where we're at today, that if that target is hit, that's going to be a drop of about 40% in the semiconductor index. And that also comes in just like my targets on the Nasdaq 100 of a long-term uptrend line off the late 2008 lows, 2008 lows, that is, I'm sorry. Remember, the Nasdaq 100 and a couple sectors, mainly tech in the semis, which are a subsector of tech, bottom in late 08, November of 08. Everything else bottom in March of 09. And that's where that trend line generates off those lows. So that's, to me, what I call a high probability target. I put pretty good odds that's going to be hit. Worst case being short, as I think maybe a marginal new high to extend the divergences before move down. But I don't favor that. That's my alternative scenario. My primary is that the top is already in, and we just need to get going to the downside, take out the recent lows, just like the market. So, and I laid out SOXX as one possible trade idea. But maybe I didn't give you targets on that one. No, I guess I didn't. That's a 3-time leverage. You're better off, at least at this point in time, because we're not in any type of unidirectional drop. It's kind of grinding around for a few weeks. That's why you have these targets on SOXX. And no leverage, so the decay's not kicking in there. This is when you want to be long the leverage 3-time long semis in a unidirectional rally, and this is when you want to be short in a unidirectional drop. This is when you don't want to be in leverage ETFs, when you're grinding around, chopping around. You see a lot of green closes, red closes, green closes, red closes. You want to see like this, all mostly red closes, to be short via SOXS. All right, next up. So that's one I still like. Again, The couple ways objective short entries are rallies up to the 200-day or 40-week moving averages, and or breaks a break below 435. We'll call it 435 right there, somewhere around there, especially on a weekly closing basis. Next up, I mentioned a couple weeks back or a couple months back and a few times since, home builders. This is, showing you what's going on in the market. Interest rates shot up from an average of historic low of 2.5% on the 30-year fixed rate mortgages to above 4% recently. And that puts the brakes on the housing market. You don't see it. That's one of the most lagged indicators when I look at, I'm trying to go to Zillow, watching trends. I do have, I keep a Zillow account. Houses that my wife usually, she has on the same account, and she'll, it was a hobby, just bookmark houses, and I'm starting to get a flurry of price drops on those saved homes, or an increase, let's just say. And so I just wanted to say that by the time they tell you, because that's a lagging indicator, by the time the data comes in, but that's not rocket science. When mortgages shoot up and nearly double, from a low of 2.5% to over 4%, that it's going to put pressure on the housing market. And so I watched this one and mentioned this as a good swing short months back. That's it. It's the top is in my opinion. That's a big divergent high right here on the weekly chart. We've taken out every trend line that I've had here. I had a long-term trend line coming here. We broke it back into 2018. We back tested it when COVID hit, failed, rejected, recovered it recently, but back below it again. And then more recently, this uptrend line here. Now, I'm doing an update. This one is not a hard buy at this time because you're coming up on support. I had earlier shared with you this target here, 58.53, which has now been hit. It's close enough. Low was 58.92. Consider that a hit. And so it's at support. I'll have to do this, and I could do it in another video, and this is also the daily chart here. You can see the divergence is extended since that previous divergent high right there. And this is, I think, that trend line on the weekly looked closer to this right here. So I'm going to move this one around. I haven't updated this in a while. We had divergence just like the indexes, but here's an example where that divergent low didn't play out. Now we still do. The divergence is extended. So if they're going to rally, here's where they need to rally. And that's why I said I wouldn't short it right now. We're at support. We're at that 58.70 target. However, a signature of a bull market, or I'm sorry, a bear market, would be that these divergences either fail to play out or play out for a very small bounce, and then we take out that level. So bottom line is, and I'm going to do it now in case I haven't already, set an alert. Look for a break above 58.70, and then if it happens, follow up that week. Do you have a solid close down below? If so, you're going down to 51.63 would be your next stop on the home builders. And as always, especially with this sector, you can sniff out and short the most bearish looking setups. This one, just like XHB, the other home builder ETF, they're top heavy in Home Depot, Lowe's, Sherwin-Williams, companies that don't build homes, companies that just sell home products, and so they're a beneficiary of that. But you can do a direct play on the home builders like DHI. You can see DHI. That's DR Horton, just took out 72.22 was a target support. You can see Lennar dancing on support now, but these guys again, they're in downtrends. They're in if you want to call it a bear market, I wouldn't call it that yet, but this one's dropped 25%. It's at support. So a sector to watch. Again, I'm throwing it out there because it's one based on the long-term charts. I think there's more downside. It's just maybe you want to see these levels get taken out, these support levels are at. I'm going to move on, and I will from time to time update that one. Next one I wanted to show you is, and I'm kind of all over the place here, but I've gone through all my sectors, or at least a lot of them, not every sector that I follow, but most of them, showing the ones that stand out. IAI. This is the iShares Dow Jones U.S. Broker Dealer Index Fund. So everybody listening to my voice has a brokerage account most likely, and I'm going to show you it on the weekly chart just to kind of give you a big picture here. So this is what it looks like, and most recently, and the line kind of shifted a little bit, and it should be like that right there. It most recently put in a divergent high, and that was the first divergent high on the weekly chart since back here. We had a divergent high there. We had one right there. That it was really an extension. That was the first divergence right there. That was, I'm going to measure those drops. So first one, just to give you an idea, the reason I measure these drops, it gives you a feel for how volatile the sector, how large the moves are within. And again, these I view as corrections within a larger bull market. That was a 26% drop. And back then, when COVID hit, it was a 42% drop. And so far, off the divergent high, it's only been an 18% drop. So it tells me, and that one was even bigger back here. That was bigger than 18. That was a quick. We had a little mini crash back then, 36%. So we're well below the average drops. And again, this target, my next target, and where I think they're going, meshes with my target for the markets, which is the what I call the pre-COVID highs right there, February of 2020, before COVID took hold of the markets. That's where I think we're going. To get there, we need to take out, it's simple, we have about roughly $97, pretty good support. We're below the 200 days, so once that goes, it's like everything else, pretty much you want to keep it simple, the recent lows, just like the stock market. If that happens, you're looking at a drop in the broker-dealer sector of about 27%. Names are such as Schwab. I'm just showing you this. I'm going to keep it on this weekly chart to show you the big picture. Big divergent high right there. Okay, just like Schwab had a big divergent high back here. When it put in that divergent high, Charles Schwab fell 52%. What happened here? You had a nice clean up trend line. You have this bearish rising wedge confirmed with negative divergence, and you had a perfect, so far, a breakdown, a tag of that first support level, good support, 76.57. You can see all the resistance back there. Broke it, back tested it. So that's a really good support level. Bounced right where it should have, but then boom, right back into the trend line, back tested the wedge from below and rejected pretty impulsively. That's the thing I say, the problem with shorting back tests of trend lines like this is that you can continue to back test for a while. So it's really, I like to see that impulsive rejection that says, okay, now we've been rejected, we're not just back testing. So that's it. You know where I think it's going, and that one would have another, if it hits, you have a primary uptrend line and support there about 67.40. That'd be about a 19% drop if hit from where we're at now in Schwab. And just like these divergences work, bearish divergences, you also, stock bottom there with a big bullish divergent low right there. So those are your targets for Schwab. The video will go forever if I go through each and every one, but I'm just going to rifle through some of these big brokers and show you the common themes here, which is big divergent high, negative divergence, and this one already broke down. So this one's, offers an objective short. It broke, it had this sideways trading range here, all-time highs, negative divergence, and recently, again, we're on a weekly time frame, it broke it, took out the 200-day moving averages as well, 40 weeks right there. You can see the red and blue lines. Back tested the 40-week simple moving average 2 different weeks, and it's moving lower. So really, when it takes out the recent lows, that should open the door for a much bigger drop, and I don't see anything really, zigzags along the way, not, aside. This one's probably headed down there at about $57. Again, the pre-COVID lows, 57.50 or so, or pre-COVID highs, I'm sorry, excuse me. GS, Goldman Sachs, boom, divergent high, again, weekly chart. Primary trend line's been taken out, broken, and back tested, along with a perfect back test of that price support, or former support. Once broken becomes resistance. 371.82 went down, hit my next target here at 316.65, and it's been dancing on it. When it breaks that, it's coming down here. My opinion, next stop 272-ish. CME, we can go down the line. That one looks holding up better than the rest. Divergent high, still above trend and support. I think that's a beneficiary too of all the commodities trading. A lot of those commodity futures are traded on the CME, and that's probably seen a lot of nice trading volumes there. ICE, the exchanges are holding up now, but you want to set alerts and watch those. There's the Nasdaq. Nasdaq's actually broken down. That's the uptrend line. This is the Nasdaq exchange, NDAQ. There's the negative divergence right there, right? Last time you had negative divergence, you had some right there. You had a nice correction there. But this one was really nice. You had a clean uptrend line, breakdown, back test, impulsive rejection, took out the 40-week slash 200-day moving averages there as well, and it's back testing, and you have a little potential flag there. We'll see. Targets about down there at about 135. I'd give you one more if this one plays out. All right, I'm going to move away from these because I could go and give you the individual setups and show you that some have yet to break down and others already have broken down, which makes me think the rest of the lot will follow. And that's RJF, Raymond James. All right, I want to get through this video, so I'm going to go to the next one up here and just show you real quick. IYT. Transports have been strong. Bullish pundits, those bullish on the economy have cited the strength in the transpos as a reason the market's going a lot higher. But what I see is a sector just waiting, like everything else, to take out the recent lows. This again is a weekly chart. I'm showing you big picture stuff here. That's our divergent high right there, negative divergence. And we have, just like so many indexes and sectors, a recent toppy pattern. Remember, this is what the small caps look like in a lot of other sectors. They had these multi-month, or in this case, just like RTY, the small caps, or IWM, I'm sorry. We had a year-long, we are in a year-long sideways trading range, and therefore a break below that is going to be a big sell signal, especially a solid weekly close. So I've got an alert going there, 243.71 roughly. You want to call it 243, 240 if you want to be very safe. But thing about that is, sooner you get in, if we have a big drop by the end of the week, this thing could be way down here, and I think it will be. There's a lot of energy built up in here. I view these as like coiled springs, these consolidation patterns. Here's one right there, right? You can see it right there. See that coiled spring? And when it broke down, boom, it was powerful. And if you waited a couple weeks for the, everyone come out on TV and tell you, hey, the indexes are or the transports are broken down, yeah, you missed most of the move. It was too late to get in because that by 4 weeks, the whole thing was over. And there was another breakdown there. It was similar, even before COVID hit. All right, so that's that. Transpose, and then of that, I don't think there's an ETF. I'm going to check. I meant to do that for you. Railroad ETF. There's never been that I've known of a railroad ETF, but the railroads really look toppy to me. This is DJUSRR. That's the Dow Jones U.S. Railroad Index. This is a weekly chart. Railroads have been strong lately. They've been one of the best performing sectors, and so I've left them alone, but now I'm going to start picking on them. We have this big I'm going to move this divergence line to where it really comes in. It comes in about right here. That was just a longer term trend line. There's your negative divergence. You could actually bring it all the way over if you want, but doesn't matter. It really doesn't. It's just negative divergence, so you can see leading up to the recent highs. And no sell signal yet because we're right on trend. This is a weekly chart, but let's step down to the daily, and I'll show you a few individual names. There it is. Nice, clean for the first time in a while. Big negative divergence. You also have an ascending broadening wedge pattern there, aka megaphone pattern. We're coming off the top pretty impulsively so far. I haven't fully marked this chart up yet. I'll give you one target there. I'll give you one more right here. These are my initial targets right there. Support is about 33.95. Now that's the index. So what you want to do, let me queue up the railroad stocks. Let me pull this up. It's going to give me a watch list of all the railroad stocks. UNP, Union Pacific, divergent highs, starting to move down impulsively. Any or all of these are potential targets. I think all the way down here, I'll call this one down to 188.57. So we'll call that 190. Negative divergence right there. CNI, Canadian National Railway, same story. Negative divergence. I'm not crazy about the trend line, but there's some really good support there. 119. Break of 119 should bring us down to 100. That's going to be about obviously a 20% or so drop. CSX, broadening wedge pattern as well. Support roughly 34.46. Target right here. Again, I haven't polished all these charts up. It's been a while since I traded the sector, but I'm going to start turning on levels for you. 29.85 minimum target, and I think once that goes, and I think it will ultimately, then we should come on down here to this level, which is 26.63-ish. NSC, Norfolk Southern, Divergent High, blah blah blah. So same, birds of a feather, guys. Of course, and that's the story on this one. So pointing out a sector that looks ripe for breakdown. WAB, Divergent High, pulse of rejection lately off that Divergent High, needs to take out this trend line and should continue lower. All right, so I'm going to move on now. Autos, I'm just showing you auto sector. Really, I don't see a hard entry on these, but just showing you what's going on with the economy. Here's Tesla, obviously. Oh gosh, there was a chart. I wish I had it for you. It showed year-over-year auto sales. The Journal put it out today. Tesla's the only one that was positive. They're all of them. Every other one, all the automakers are negative. It shows you demand is slumping. And yeah, I know they can't get enough chips to sell a lot of cars, but they're also sales are down. Sales are down. That's it. So and it's showing you decreased demand. We had the chip shortage last year. Toyota Motors well off the highs so far. Again, I'm just showing you what's going on in the economy. Ford broke down from that divergent high there, and it's already dropped almost 40%. And it doesn't appear that the correction's over. I don't see any evidence in the charts that say that. And these are daily charts. Probably should go to the weekly charts. Yeah, that gives you big picture stuff. Tesla, it'll come. Tesla will have its time. Yeah, it's selling, it's doing better because it's a smaller company. Has a smaller baseline. It's selling, increasing sales, I should say, more than the others. It's not selling more units than the big ones, but Tesla, it's just big divergent high. Toyota Motor Company. This is again big picture stuff. Put in that big divergent high. Very, very, very well-defined trend line. Broke it, followed by an impulsive drop, coming up, back testing, and should come on down here to 145.45. If so, you're looking at a drop in Toyota of about 20%, 21%. Ford, alternative trend line there, primary trend line, near-term trend line break right there, big divergent high, dancing on support right now, 1587. When that goes, I should say, 1350 is my next stop on Ford. GM, again, just showing you stocks that are in a bear market and have rolled over. Everybody's lately buying tech because the bargain hunters, the dip buyers, finally got, for the first time in years, a big correction in Apple, Facebook, Amazon, the crowd favorites. So they're buying those. But yet this is showing you what's going on in the economy. When you're seeing, the automakers falling, it's showing you that finally this red hot consumer craze with all the extra stimulus the government pumped in the markets. It's run its course. Car sales are dropping. These guys are at support, and again, this chart looks like death. Looks like more downside to come. And then I could go through each one, but I'm not going to do that now. I've pointed this out before too. XRT. You want to know if the consumer's dead? Well, if the consumer's still, strong right now, why is XRT, the retail sector ETF, why does this chart look like this? This one's got a lot more downside to come. This one's already fallen. This sector from high to low has fallen 32%, and we're not off that low. So you take out that recent low, we're going to come on down here. I see more downside in the retail sector. So this is really the economy. Facebook, Microsoft, Apple are not the economy. They are a big part of the stock market. But ultimately, when everything else buckles, then the consumer folds and the economy does. Banks, we could look at BXK. Or BKX, I'm sorry. That's the bank sector. Again, on a weekly chart, I'm kind of painting out big picture stuff to you. Big divergent high right there. Trend line was broken, putting the banks on so the banks have topped. This was big bearish rising wedge on a weekly pattern. Last time I had a bearish rising wedge on the weekly on the bank sector right here, from that top that it put in with the divergent high. Let me grab just right there. Well, the first leg down was 32%, but before all said and done, it never made it. It made a lower high after that right there. And before all said and done, the sector fell 52%. Right now, it's only, quote unquote, fallen about 18, maybe almost 19%, 20%. Hasn't even hit my first target. At bare minimum, I think it's coming down here to 1546. That's another, from where we're at now, another 5%. And then probably go lower from there. Again, that looks like a very toppy sector. Oh, and then of course you could do XLF. I already did that broker dealers. They're a subsector of financials. The big banks are here. Again, same story, divergent high. So these are the sectors I'm going over that are bearish and you can short. And I've covered XLF. I've covered all these individual banks. JP Morgan topped. Boom, right there. Major top, heading lower. Took out recently the uptrend line right there. There was our primary bull market long-term uptrend line. We broke it when COVID hit. Comes off the 2009 lows. It was a breakdown right there. This is, by all accounts, should have been the beginning of a larger bear market, but the Fed came in with the nuclear option, overstimulated the market, staved off or delayed, I should say, the bear market that's probably coming upon us soon, or underway now, I should say, really underway now. And that's it. So we overshot, briefly regained it, but we're back below that long-term secular bull market uptrend line. These are cyclical bull market, cyclical bear, cyclical bull, cyclical bear, cyclical bull, cyclical bear. But this is a secular bull market uptrend line that's been broken, and that doesn't bode well long term for the banks. And they all look similar. Bank America, toppy, right now flirting with the uptrend line off the COVID lows. Actually below it. It cracked it recently. It came down, was trying to gain it, trying to hold it for the last few weeks. We're below it. So that opens the door for move down. So there's your short trades. XLF, if you want to use juice, 2 times short is XKF, 3 times short is FAZ. So you buy those to be short. It depends how much leverage, if any, you want to use, or you just short XLF, or you short the individual banks. Let's see. Oh, well, let me give you something for the bulls. I know sometimes one says, Randy, you're just showing me bearish setups. I don't short, or I'm bullish on the market. Biotechs look about as good as anything I've seen recently. They put in a divergent low like the market did lately, but they haven't run. They broke out of their downtrend line at resistance now. The thing is, if there's a broad-based sell-off in the market, it's going to be hard. The Nasdaq 100 or the Nasdaq Composite also has a pretty good weighting of biotechs. But, if it can pop 97.90, there's your next stop, next resistance 108, and then 1810. Back here we put in a divergent high, pointed that out, and biotech's been in a big bear market since. So one of the better looking sectors out there, in my opinion. But I'm going to cap it here. Yeah, let's do that. I covered everything I wanted to cover. Let me get the video out to you guys. Again, some of these are actionable. The ones that aren't hard sells right now, if it's not a break of support on a stock or an index ETF, look for a bounce back to resistance. Again, if it's a bearish trend or bearish outlook on the chart that I covered, look for a bounce back to resistance or a break below support. And if it's a sector also, I encourage you to look at the holdings. Biotechs, you're going to have a wide diversity among the holdings. Automakers, they tend to move more in line together. Home builders tend to move more in line. But again, the home builder stocks. So as I said, if you short ITB or XHB, you're also shorting Home Depot's lows, all those, but they will tend to fall with it as well. So you can, the benefits to ETFs, you probably know this is safety, diversity in numbers. You don't have to worry about one earnings beat clocking you with a 20% loss, a big gap up in the morning or a gap down against your position because the company that you held blew away or missed earnings or some other shenanigans they were doing. That's the benefit. But the downside is you're diluted. It's safety in numbers, also holds down your performance. If you can sniff out the most bullish or bearish stocks within a sector, go long those or long the bullish ones or short the bearish ones, you will most likely outperform, or you will outperform the sector ETF. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.